Hello everyone, welcome to the first part of our discussion about liabilities. This is going to be, there's going to be three podcasts, three parts. First one here, we're going to talk about liabilities a little bit in general, current liabilities, that sort of thing, contingent liabilities, and then the second one will be long-term liabilities with interest. And then there'll be some examples that we'll show you in the third podcast of how the journal entries and T accounts might work with these items and the calculations, especially in Excel. So, first of all, remember, kind of review what a liability is: future sacrifice of assets or services because of a past event. Remember, some event has to happen. Okay, there cannot be just this thought that something bad could happen that for liability. The event has to happen. It doesn't have to be for sure the amount. So there could have been a lawsuit. There could have been a finding of a leak underneath our building or something. Some of those we may not know what the ultimate amount will be, okay? But as long as we can estimate that, then we may have to record a liability. So, but just a possibility does not count. So if the employees are working and we owe them money, supplier has delivered inventory. Okay, so another example, if I agree with a supplier that they're going to bring us inventory, that's not a liability. If they deliver it and now their agreement is that I have to pay them, that's a liability. So it's not until they actually deliver it. So a current liability is due within 1 year. So the examples that have come up already: accounts payable, interest payable, accrued payroll liabilities, the amount of money that the employees have earned but have not yet been paid because there's always a delay in paying them. Short-term debt, where we borrow from the bank or something for just like 6 months or 8-9 months because we need some cash right away. Unearned revenue, and most of the time is going to be current because somebody has paid us and we're going to provide them with services in the future. Sometimes that will be longer than a year, but most of the time that's within a year. And then the one that sometimes will trip us up a little bit: current portion of long-term debt. If you think about a car loan or a mortgage, you pay every month, but the actual loan is due over a long period of time. A mortgage, 30 years. A car loan could be 6 or 7, 8 years. So the amount that you're going to pay in the next year is current on a 5-year loan, and the other 4 years is long-term. So we break that into two pieces so we can communicate to our investors just how much is actually due in the next year. So let's talk about gift cards. When a customer pays cash for a gift card, they come into the store, they buy it at Giant, whatever, they buy a gift card, the company on the gift card receives the cash. So if it's a Burger King gift card, then ultimately Burger King is going to get the money. If Giant sells it for them, they're going to take a little fee for selling it, but Burger King's going to get the money, they're going to have the cash, and they're going to have a liability, unearned revenue, or if you're being very specific, unredeemed gift card liability. And Burger King will then has an obligation to provide goods or services to whoever holds that gift card. All right? So their obligation is whoever brings that in to provide them with a meal or whatever up to the amount that's on there, so forth. When they redeem that, when the person who has the gift card comes into Burger King, the sale is recorded just like a regular sale. We would record the cost of goods sold, we would record the reduction in inventory, okay? But instead of debiting cash for the sale, we would debit the gift card liability. It would go down. And we would credit sales just like we would if they had paid cash. Okay, it just says the regular sale. So on this one side, it looks just like a regular sale, except for one difference, and that is we're debiting, instead of accounts receivable or cash, we're debiting the liability, unredeemed gift card liability or unearned revenue, whichever term we're using. So gift card liability goes up with the sale of the gift card and goes down with the redemption of the gift card. So then we have to deal with the possibility that maybe it's never going to get redeemed. What happens when the customer loses, for some other reason, does not redeem their gift card? And I don't know about all of you, but I have gift cards that I probably won't ever use because I used up all but a couple of dollars on it. It's not worth it for me to go in and redeem those last $2. So chances are very high that will never get used. So it doesn't necessarily have to be the whole gift card was lost. It could be that it just doesn't seem worth it to do it, and so they're never going to do that, bring it in. So is that liability on there forever? So that's the question. Is the liability just stay there forever? Now, actually, companies are counting on this possibility. That's one of the reasons why they sell so many gift cards, why you can buy gift cards at almost any store now for the store that you're at, plus a whole bunch of other stores, because everybody wants to sell them. Gas stations sell them everywhere because they do plan on some of it never having to be redeemed. And that part that is never going to be redeemed is just revenue, is what it's going to end up being. So after a year or so, they look at the gift card liability and how many gift cards are outstanding. So they have a list of all the cards. They may not know exactly who has them, but they know how many have been sold. They have that in the computer. They know what date it was sold, how long it's been. After a year or so, maybe 2 years, they look at that amount of those cards that were sold and have been outstanding for that long and say that a good chunk of this or some of this is not going to get redeemed. We're going to estimate how much of that. So maybe it's 25% of that is never going to be redeemed. This is an estimate, another example of an estimate we talked about way back in your introductory accounting class, the idea of having to estimate things. That estimate or that amount that's never going to be redeemed is going to be a debit to the gift card liability and credited to sales or to revenue, whichever you like. And there is no cost of goods sold. You don't have to actually give it to them. We're just going to count it as revenue, even though we're not actually transferring any goods or services. That's the best, I hate to break it to you, but that's the best case scenario for the business, is that they get revenue with no costs. No merchandise given to the customer. So they're kind of hoping that happens at least 4 or 5% of the time of the gift cards they sell. All right? So that's referred to in the industry as breakage. Sometimes you'll see that in the footnotes description of this process that they're estimating. So we got the journal entry. When we have breakage, we're going to debit liability and credit sales. Warranties, another kind of unusual, and there's 2 types of warranty that we're going to talk about, and the accounting for each of them is a little different. So what is the warranty? A promise to fix or replace an item if it's found defective with a certain length of time. So there's usually a 1 year, 2 year time period in which the company is promising. So we've got this obligation that generates a liability. Sounds like an obligation. We sold products, and We do this when we believe that the warranty has an influence on the customer wanting to buy the product. Okay, so we're talking about things that are a little bit on the bigger side. Washing machines, cars, that sort of thing, have warranties that actually have value. When you buy something that's cost you $7, it may have a warranty, but you don't care because you're not going to send it back in when you paid $7 for it. So, how much is this obligation? Obviously, we don't know exactly what the obligation is. We don't know exactly how many are going to need to be fixed or replaced. Okay? But they are sold at the same time. These type of warranties we're talking about now are embedded. They're sold with the product. They just go along with it. You didn't have to sign anything extra. You didn't have to pay any extra. Okay? So the company that sold the product to you with the warranty embedded is going to estimate the number of products that we return. So it may be 2%, 5%, 10% of the products sold, and the cost to fix them. Each one of those when they come in. So we're making two estimates. How many are going to be returned and how much we're going to cost us to fix each one of them. We're going to then record an expense now, even though the items haven't been brought back in. We're estimating. We're going to multiply the number of products returned times the cost to fix and record that in the same year as the sale to match the cost of the warranty with the revenue that warranty generates, because the idea is with customers bought more of it because of the warranty. So an example, we sold 5,000 washing machines with a 1-year embedded warranty. It's part of the price of the washing machine. We estimate that 2% will need warranty repair in the year time period, and each washing machine will cost $200 a fix, including parts, labor, transportation, etc. We multiply the 5,000 washing machines we sold times 2%. That's how many we think are going to come back. We multiply that number by 200 to get $20,000. So we expect that this will cost us for these particular washing machines $20,000. We don't know for exactly, that's our best estimate. Based on our experience in the past, based on other people's experiences. We then record that as a debit to warranty expense and credit warranty payable or warranty liability, however you want to say it, at the end of 2020. We want that expense in the same period as we record the washing machine sales, right? We want to match those two in 2020. So what happens when that washing machine that is under warranty comes in for repairs? Let's say that happens in 2021 and we pay $300 to fix it. The journal entry is going to debit warranty liability. So we're going to make the liability that we owe go down because we've done it. We've taken care of our obligation. And we're going to credit cash. Okay? Now it could be that you're going to credit inventory if you replace an item because you're going to take it out of the inventory. But for the most part, it's going to credit cash. Some asset is going to be transferred in order to take care of this warranty. So at this point, we're taking care of the liability and not recording any more warranty expense. So the warranty expense is recorded at the time literally of sale when we estimate, not when we actually fix the items. So estimating warranties makes expenses go up and liabilities go up. If you need to adjust the warranty, you need to make it higher. That's the journal entry you're going to need to make. You're going to need to debit expenses and credit the liability. When you fix the products, it makes the liability go down and cash goes down and does not affect net income. Now, different kind of warranty. Some of you have had somebody at a store or someplace online offer you an extended or a separate warranty, one that you had to pay additional for. When that's the case, we deal with the journal entries and the accounting differently, because we're going to have extra cash come in, right? So when it's sold separately from the product, we're going to record the cash coming in, debit cash, customer paid us, right? And we're going to record it as a credit to unearned revenue, a liability, which we may call extended warranty liability. Now, if you have both kinds of warranties, you're going to want to have a liability for embedded warranties, and you want to have a warranty for extended warranties, just to keep them, to help you with your accounting. So when the cash is received, you have this liability. You don't estimate it in the same way as you do with an embedded warranty. As the time period goes by that the warranty is covered, so if it's a 1-year extended warranty, as the year goes by, we debit the unearned revenue or the warranty liability, whatever you call extended warranty liability, and we credit revenue. So you might do it every month, or you might wait till the whole year is up for the extended warranty, and then record all of that revenue for the whole year. And again, you're moving it from unearned revenue to earned revenue because the time has gone by. When items are fixed under an extended warranty, all right, we simply debit the expense and credit cash. So when you fix items under an extended warranty, then it does affect net income. When you fix items under an embedded warranty, it does not affect net income. So but it does not affect the liability under an extended or separate warranty. All right, so that will be, most of those will be current liabilities, but we really didn't say, for instance, borrow money. So our next podcast will really get into what happens when we borrow money and the different ways that we can borrow money from banks or other financial institutions.